All right. Hey everyone, it's Ben here, and today we're going to go over the Salesforce DCF, discounted cash flow. And hopefully you guys all noticed, if you've been watching my previous videos, that I've made some upgrades to setup in a sense. I'm a circle now instead of a square. And I also upgraded my mic, so hopefully this sounds better. But with that said, let me briefly go over the agenda for today. First, we'll just go through a brief Salesforce situation overview. Then I want to chat a bit about our sponsor for today, Wall Street Prep. Then we're going to do a really brief revenue build for the company. Then go into the discounted cash flow. And there we're going to do a WACC analysis and mid-year convention. And then we'll discuss the price a little bit based on the model that I create. Some friendly reminders. This is a high-level street-based DCF. So normally you want to have your research back every single assumption that you build and have your own assumptions, but that's pretty hard to do as kind of a retail investor. So we're going to rely on the street and work with ranges in order to see what we need to believe to invest or not invest into Salesforce. Second, this is not financial advice. So while I do talk about things like whether or not I would invest, like price discussion, stuff like that, is more for educational purposes. So please remember that. And lastly, the model will be available for purchase after streaming at rareliquidcareers.com. So if you're not watching this during the stream and you're watching this after it's already been published, then feel free to check that out if you want. And with that said, let's go into the situation overview for Salesforce. So Salesforce reported earnings last week, and the stock slid. Let's try doing a bit more zoom. So you can see that it was around $180 and it fell down to $168 because this is when it published earnings, and then it kind of slightly rebounded and now it's come back down. And let's kind of go into the reason for that. So the big headline really is that Salesforce trimmed full year expectations for earnings and revenue. So it was not really about what Salesforce or how they performed this past quarter, but much more so their guidance for the future. And you can see that in this other article that I pulled up here. Why did Salesforce stock go down? Lowered guidance gives investors concerns. And a few other things I want to highlight from their latest quarter. So they actually beat quarterly expectations, but they came up short on guidance, which is why the stock fell a little bit. Second, the Salesforce is also raising prices on Slack. So one thing to know about Salesforce is that the company has been acquiring a ton of other companies, and acquisitions are a huge part of its growth strategy. So just something to know about the company that's pretty important. And then the board has approved a $10 billion buyback program, the first of its kind for the company. And so buybacks, when it says it's been approved, that doesn't mean that it's going to actually buy back 10 billion stock right away. It just means that Salesforce now has the option to. And this kind of provides confidence to investors, or it's supposed to signal to investors that the company is it believes that the best use of its cash is to buy back its own stock because it's undervalued, right? But again, it's just an approval. We'll see what they actually do. Just to go into the numbers just a little bit, here's how the company performed. Earnings $1.19 per share versus the expected $1.02. And then for revenue, $7.7 billion versus around 7.69. So slightly beat on revenue. Revenue in the quarter grew by about 22%. Pretty good for a company of Salesforce's size. And here's where things really kind of went poorly for the company, I guess. Salesforce reduced its fiscal 2023 guidance for both earnings and revenue. And I won't go into all the numbers because you can read them right here. But what's basically important is that with the potential recession, or with all the interest rate issues and all of that, that is what's causing a lot of companies to kind of slow down their projections for the future. Over the past 2 years, everything has been kind of going crazy with companies just like beating and raising guidance like all the time. But things are slowing down now because of the inflation, interest rate environments, all that stuff. And so that's why companies like Salesforce are lowering their guidance. Okay, so that's like the brief situation overview for Salesforce. Let's next go into Wall Street Prep. Brief message from our sponsor for today's video. And I've been working with them for a while, and they are basically a company that trains a lot of the analysts at the top investment banks and institutions. I just got an email about a week ago or 2 weeks ago because I'm currently getting my MBA at Wharton, and they actually partner with Wharton because they allow all students to get access to their courses and things like that. And so kind of a well-trusted financial modeling training provider, I guess. And the course, if you look at their courses, there are a ton of different ones you can use, potentially look into. And if you use my code rareliquid, you get 20% off. So if you are interested, be sure to use that code if you want the discount. And as you can see, there's just a ton of different options you can choose from if you're interested in modeling in a specific industry, if you need accounting help. There's equities markets, if you're like recruiting for ECM, Excel, and PowerPoint courses. They have a ton of stuff. And the one I recommend if you're new to finance is accounting, because it really provides the fundamentals of everything you need to know in finance, really, or it provides the fundamentals to learn how to start modeling and work in the finance field. And then the premium package financial modeling program is what is most popular on Wall Street Prep. Over 100,000 students have used it so far. Use my code rareliquid, you get 20% off of this. And you'll learn everything that I learned in investment banking, like financial statement modeling, DCF modeling, M&A modeling, trading comps, transaction comps, LBO modeling, and a whole lot more. So feel free to check them out if you're interested. There's a link to it down in the description below. And so that was number 2. And next, now we pretty much just need to build our model. So let me zoom in. You guys can all see what I'm doing here. And similar to other streams, I'm not going over my too many like shortcuts or anything like that, but I do have videos about DCF basics and like tutorial and stuff like that, and Excel shortcuts down in the description below. There are other videos for that. Okay, so start off with the normal stuff. We'll have a ticker, we'll have the date, then we'll have some assumptions here. And I see a question asking why I'm up at 4 a.m. I'm actually in Philly right now, Philadelphia. So I'm on the East Coast. And I have class starting at 8:30. Trying to do this model before classes start, basically. And yeah, if you've been following this channel, you know that I haven't posted in a while and just been so busy with classes that I'm trying to get back into I'm trying to like figure out my schedule and how I'm going to manage rareliquid and everything. And so we'll see how that turns out over the coming weeks. I mean, nothing's alarming. I just need to basically get into the swing of things, and then I'll be back posting on a more regular basis. Right now, I'm just doing a little bit of formatting. We're gonna need assumptions. We're gonna do a really simple revenue build. Right. So, oh wow, Richie, you're always tuning into these streams. Okay. Statement or cash flow statement, or so let's call it cash flow items. DCF. All right, so we're going to first start off with the revenue build, as I mentioned. So I pulled up some of the items here. Starts off in 2013. Oh, Belgium. What time is it in Belgium? While I'm building out all this basic stuff, actually, I do have a question for a lot of you. So if you guys have been following the channel, you know that, or if you've been if you have been following the channel for a really long time, since it started basically. So I used to have this channel for career related videos and also investing related videos. Now it's only pretty much focused on investing. And I have a separate careers channel for like career related content. But there's kind of a mix of a lot of you guys from people who are interested in both career and investing stuff. So I'm curious to know, well, maybe you guys are all an investing crowd, but what kind of videos, like, are there any other types of videos you guys want to see? Or what do you really come to this channel for? I guess it's kind of a broad question, but I was just curious. Not looking for any like mind-blowing answers or anything, but while a lot of you guys are here, curious. Okay, so now revenue build. So while you guys answer that, I guess I'll work on the rest of the model. Ooh, I need to save this document. One really quick tip for those of you entering into any kind of industry, really, for work, really helpful to start your file names with the year, then the month and the date, because if you do it this way, then it'll always be updated. You can always organize your files by the date. And if you have a lot of different versions and stuff like that, it's really helpful to do it this way. Okay, so the only detail we have for the product segments are subscription and support and professional services. So I'm just going to build out the revenue model for these two things. Okay, so for this, we are going to have a conservative case. Base case, or which will be our street. And then our optimistic. So now let's actually just plug in the figures. That was for subscription and support, and then we have professional services. And as you guys may have seen from previous streams, it's always good to color code your cells so that when you're looking at it later or auditing, when someone's auditing your model, they'll be able to quickly understand it in a sense. So green means that it's linked to another cell in a different sheet, like you see here. And these are all actuals, and then after this is where the estimates come into play. So put a line right there. And you can just copy paste this as well. I'm going to need the growth rate. All right. So let's look at the revenue growth rates. Pretty healthy for subscription and support, 30 in the 20% range. But we should remember that a lot of Salesforce revenue comes from acquisitions, or their growth does. So just something for us to keep in mind. Okay. So I haven't yet decided if we're going to do a 10-year or 5-year DCF, but probably a 5-year or 6-year because 2022 is kind of almost over. So that would mean one more year here. Keep things simple, we'll probably do a 5-year DCF. All right, so first thing we're going to need to do is build out the, well, let me think. Okay. Well, let me just format things out first. And I do see a bunch of questions on the in the chat, and after each section, I'll take some time to answer questions and stuff like that. While I'm modeling, it's hard to kind of like focus on the chat as well. So that's what I'll do for that. Okay. So right now what I'm doing, you'll see why I'm doing this, but I just wanted to take a look at the estimates for what the street is estimating for each of these revenue segments, and then kind of just seeing what we can use. Since for our street case, I think we can use most of what the street is projecting towards, but then these latter years we don't have, so we're gonna have to kind of figure that part out. So for 2022, we're just gonna get it straight from our estimates here. And let's take a look to see how reliable some of these estimates are. So because if you've watched previous models before that I built, you know that these brokers a lot of them drop off after a certain year, and then that's when the estimates aren't as reliable. So it looks like Salesforce actually reports their fiscal year end on January 20 or end of January in each year. But we're looking at the full year or the year end of December, so calendar year end. So this basically we can think of as the end of 2024. And you can see a lot of people drop off. So a lot of analysts, I mean. While for 2023, a lot stay on. So 2022 and 2023 are reliable. 2024 onwards is a little bit unreliable. Just going to note that as an X here so that I remember that. So I think for these first 2 years, we can kind of just go with the street because they'll be pretty accurate. And then we're going to have to kind of like build this down. So the street thinks basically 2021, 2023, okay. So these two we can use. 2024, 2025, these are a little bit not as accurate. And you can also see that in the numbers, right? It goes from 17%, 15%, then 16%, and then 10%. Like why would growth increase and then suddenly decrease, right? Or sorry, why would it go up by 1% and then dramatically fall by 6%? The analysts don't have like a crystal ball that can predict this kind of weird growth rate. It's more that the numbers are a little funky. Okay, so falling by 2%, I think here. Okay, so we're gonna have a bunch. Okay, let me actually just copy paste one of my other documents. So this is going to be a bit of a shortcut, but otherwise I'm going to be late to class if I don't do this, to be honest. Okay, so let's just copy paste this. Then I'm going to delete all the numbers. Okay, so for revenue build for 2027, that's what we're going to need. I might need that later. So for our street base case, it's decreasing by 2%. If we assume that each year, that give us around 8%, around 7%. So let's call this around 7%. See what the numbers turn out to be. And I'm color coding this purple because that is what we used to use at JP Morgan for when you're linking to something in the same sheet. Okay, so to linearly grow this down, we have our previous year minus the difference between our previous year minus our last year. Divide all of this by number of years. Okay, so this is linearly growing it down to 7% or so. I think it might be a little bit up. Well, let's see. So the company has been growing in the high 20s. Wow, over the past, I don't know, 8 years or so. And well, some of this may be because of acquisitions, but even still, it's a pretty good track record. And so this slowdown, I think, is a little bit on the conservative side. I would say that 7% sounds like, yeah, it'd be pretty conservative. Let's see if 8%. Okay. I don't want to be overly optimistic with my figures, and we have the optimistic case for that. So let's just call it 8%. I think this is reasonably achievable for Salesforce based on its track record. And then let's go into the conservative and optimistic case. So conservative case for 2022, we're just going to use pretty much the same figure because there's only, if you think about it, there's only like a few months left, like 1 quarter left for Salesforce or in the year. And we're most likely the analysts, are going to get the number like fairly correct. So I don't want to worry too much about 2022. Let's think about 2023 though. Here, I think what we want to do is have a 90% of 2023, and then optimistic case we'll have like 110%. So this will be our projection multiplied by our 90%. I don't know why it's doing this. And then this will be that times 110%. And then now we have to figure out what it'll grow down to. So for our conservative case, then our optimistic case. Okay, so for our conservative case, if our base case is that it goes down to 8% in 2027, I think something like a 5% 5% growth would be conservative there. And then on the optimistic side, I don't want to be too high. I think around 10% would make sense. And let's copy paste these now, but we're going to need to change parts here. Okay. Okay, so we have our figures for our first part of our revenue build. And let's now create the switch. Revenue, this is for sub. I'll just call it sub. And then we'll have a separate switch for professional services. It's funny that you say my glasses make me look younger because everyone always tells me I look too young. I kind of feel like I need to look a little older. Anyway. Okay, so offset, what we're going to use for our switch. All right, so we have our first line for our revenue. And this is on the conservative case, but you can see here when I change these toggles to like 2 or 3, everything changes. That's the whole purpose of building out kind of a flexible model. Okay, and then now we're going to have to do it for professional services. Okay, so let's see. We're going to follow a very, very similar pattern as our last revenue line. So let's go into 2022 for our growth rate here. And then we're going to use that for 2023 as well. Use the same years for our for our 2022 figure, and then 2023 label these actually. One switch. Okay, so let's see what the numbers look like here. So high, so 40% to 20 to 30% to 14%, now 42% in the past year. Most likely due to an acquisition. or it's COVID related. It's one of those two things. And then it's going to grow down to 25%, then 14%. Let's see what the rest of the figures look like from the estimates that are kind of unreliable. But 11%, 9%. Okay, so I think this is somewhere where we have to be maybe a little bit more on the conservative side. Just because the street thinks that it's going to grow down to 14%. So it's likely going to slow down unless Salesforce makes another like big acquisition or something like that. So I think for this one, we want to keep it down, lower to something like 3%. And we can do a similar kind of thing for our 2023 figure of taking 90% for the conservative case and then 110% for the optimistic case. Okay, and then we can probably just copy paste this. Move down our cells here. So this is pretty much the only time really when I use the mouse. It's just more, it actually saves time to use the mouse for this particular, for that particular kind of exercise or task. Okay, so this actually seems a little bit too conservative. I think keeping this around 5% might be better. Yeah. Okay. And then let's get our 2023 figure. And then let's grow this down to, we're being pretty conservative, probably around 2%. Oops. Conservative case 2%, optimistic case around probably 7% or so. Actually, probably a formula or way I could build this where I don't have to do this at all. Where I can just copy paste everything. That would actually, I figure that out right now. I'll do it next time because I'm almost done with this part. All right, so now we have our revenue build pretty much built out. Okay, so now, so we not need to build out our next switch. Now we have our revenue build. So that is how it's done pretty much. Not super complicated by any means, but this is a very simplified DCF. The previous DCFs I had built at JPM for these like biotech companies were insanely detailed. So this is not too bad. Okay, so get our total revenue figure here. Okay, so we have our total revenue figure. And as promised, so now I'll answer a few questions chat because I do want to make sure I'm answering some of your guys' questions. So starting from the bottom, actually, what time zone? I'm in East Coast right now, so it is about 7 a.m. I have class at 8:30, and so I'm trying to finish it before then. Probably I'm gonna end up being a little bit late. Where can you download 3 statements? BAMSEC.com. For historicals, you can go to Yahoo Finance, Google Finance. A lot of them will have it. And I see that you're watching this DCF rather than Artemis. Not sure what Artemis is, but maybe that's a cool show I should check out. But I appreciate you watching this over like a TV show. FactSet per year is around like over 1,000 per month. I think it really depends, but I pay around 1,300. And do I think doing 2 to 3 courses on financial analysis and modeling will give the same insight someone with a finance degree? Honestly, I don't think a degree will actually teach you about modeling, because a finance degree is probably more theory based. And so a course that's focused on modeling will probably teach you more exactly that specific skill you're looking for. Depends on the school, of course. But for me, I guess I did a business administration's degree and I didn't really learn anything about modeling. I took like corporate finance classes, but I guess depending on the class, you could learn. Do you have a video on websites you use to get your information? Oh, I don't, but that is a good video idea, so I'll keep that in mind. And how to determine WACC, we're going to do that a little bit later. So, all right, we've built out our revenue build. Now we need to just link to our income statement items, get our cash flow items, and then we can build out the DCF. Okay, so what we're going to need to do here is get our revenue and our percent growth. And our EBIT, which is then a percent of sales. And then we need our taxes. And for our cash flow items, what do we need? We need our D&A. And we'll look at this as a percentage of sales and also as a percentage of CapEx. And then we'll need our capital expenditures. And for this, we'll also look at this as a percentage of sales. And then for this, we will need, we also need change in net working capital. For this, we'll look at it percentage of sales, and also a percent of change in sales. All right, so revenue, we actually already did that here. So, but we don't have a growth rates. It's kind of redundant to do it like this, but oh well, I'll just do it like growth rate. Then we need to link to our EBIT, which is our operating income. Now we're not necessarily going to use all these figures, but I'm just going to have it here just in case we need a lot of these figures. And what I mean is 2024 and 2025, these, as we had discussed previously, are not super reliable. Let me actually highlight these to make sure I remind myself about that. then taxes. Okay, so we have our income statement line items for our DCF. Next, we'll need our cash flow items. So let's get our DNA. And DNA for Salesforce is a little odd because it's growing until 2024 and then it dramatically decreases. Like these numbers are just not useful at all. I'm not exactly sure why, but that'll be something I'll look into later. But it's something I noticed while I was pulling up the figures. Might just be because actually that Salesforce had spent so much money on capital expenditures over the past few years with like its big tower and stuff like that in San Francisco, but not entirely sure. CapEx figures are pretty low. So let's actually look at the financial statements. Let's see if the DNA is actually really a lot higher than CapEx. Okay, so DNA we see here 907 for the past quarter, and then CapEx purchase or capital expenditures is 203. So our DNA is a lot higher than our capital expenditures, which is super uncommon. That is super odd. DNA 907, maybe it's amortization related. Okay, but we'll worry about that when the time comes. Oh, thanks. Good catch. Percentage of EBIT. Okay, DNA also do as a percentage of sales. Probably not do it as a percentage of CapEx because the two don't seem to be super related. YouTube is saying that YouTube is not receiving enough video to maintain smooth streaming, so you guys will experience buffering. Is that happening to you guys? I actually didn't pull some figures that I need. Cash flow statement. All right, let's 30. Probably stream for about 45 more minutes. Okay, cool. Thanks, Jake. Okay, I'm waiting for the figures to be downloaded. Sometimes it lags a little. All right, here's a cash flow statement. So okay, so here's a cash flow statement. Now, the number that we need is our changes in assets and liabilities thing here. The slightly annoying thing is that everything is based off of their fiscal year end, so we're going to need to like calendarize these. So what that'll mean is get 1 out of 12 here, and then that. And you'll see what I'm trying to do over there, but we're going to need our 2013 figure. Okay, so January 31st, 2013. This is essentially their 2020 or 2012 figure. And this is their, so I'll just denote that here. Well, it's the 2012 figure plus 1 month kind of. So we're going to need to calendarize. And the way to do that for 2013, for example, is to get just 1 year in from their 2012 figure, which kind of in a sense takes their 2013 fiscal year. I guess this is so we're basically just taking a month from here and then 11 months from here to get to 1 full month. That's essentially what we're doing. Okay, and we can do that for everything here, but we only really need it for one figure, what I mentioned earlier. So I'm not going to worry about the formatting or anything. I'm just going to highlight the figure that we need, which is right here. Okay, so the way we're going to use this is just link to those figures. So for 2013, let's see what this looks like as a percentage of sales, and then a percent of a change in sales. And this will help us figure out how we can best estimate these figures for our DCF later when we need to do that. So change in net working capital going to be a little bit tricky based on what I see here to estimate. But we'll get to that. I'm just trying to look into the figures a little bit to see what's driving all these numbers. Okay. So we have our income statement, we have our cash flow statement, our cash flow items, and now we have our DCF here that we need to build out. So pretty much everything that we've been building towards is here. And a lot of this we have already looked at together, but we'll have to kind of build out again. This bit. EM, I see a question. So I don't think I could build a good DCF with just numbers from Yahoo Finance. I do think basically if I had only numbers from Yahoo Finance, I would just look at the historical figures and then create estimates based on it. So then like I wouldn't have any of these figures, for example. And then I would have to just look at historicals and then come up with my own projections. So it would be a little bit more up in the air kind of like modeling. I guess I could do it. I just don't know if it'd be, I don't think it'd be very accurate. I could do it though. There's enough like interest. Okay, so then DNA, percentage of sales. CapEx. And net working capital. All right. So we have our revenue already, which is typically takes the longest to build out. So that saves us some time here. And then EBIT is something we do need to build out. We can link to our historical EBIT that we pulled earlier. Let's also grab this formatting we did. All right, so we're gonna follow a pretty similar process as we did for building out our revenue. And let me hide some of these rows so that you guys can see everything. Hide our revenue build. Okay, so there's our EBIT line. I know this looks a little weird, but I just want to make sure you guys can see everything. Okay. I also think it'd be more helpful if we looked at the projections only. So it's this, mainly the projections. All right, so ignore a lot of the weird stuff that's happening right now, but basically what I wanted to just look at with all of you is our EBIT figures here. And then we have the rest of the DCF down here. So let's start off with our street case, which is at around 20%. And it looks like the street thinks it's going to keep growing, which is a good sign for the company. So similar to our previous models or previous previous revenue build process, we're gonna assume that the street is pretty accurate for 2022 and not really worry about this one too much. And then for 2023, we're gonna go with the street as well, which is up here, 22%. And then for our conservative case, we'll do a similar thing where we have it 90% for our conservative case, and then 110% for the optimistic case. Actually, that seems pretty high. Yeah. Normally, you're not going to see like a company go from 20% to like 24%, no matter how optimistic you are. So actually, this street case is actually just pretty optimistic in general for it to increase this much. I think it might have to do with a much like stronger focus on profitability for the company or whatever. Salesforce is probably doing that for whatever reason, maybe as it becomes more mature as a company, since it does need to do that. Okay, so 22% margins, and then the street thinks that it's going to grow somewhere to 24%, but I do think that's a little bit more on the optimistic side. I think what makes sense, and it's somewhat it might be a little bit conservative, but I do think it, you do want to be a little bit conservative with your DCF, is I think by 2027, if it were to grow to 25%, that's what I would think would be pretty fair. And then our conservative case, let's call it something around 23%. And then our optimistic case will make it around to 27%. All of this seems a little bit, yeah. So, well, the company has been steadily increasing over time. Okay, the street thinks that they'll be a lot more focused on it in the future. I do think this still may be a little bit too optimistic though, so I'm going to keep it at 24%, 23%, 24%, call this 23.5. And to be honest, this is a figure that I would, if I have more time and were to really think about this or build this model out more, this is one of the assumptions I would really spend a lot more time on and make sure that I'm getting as accurate as possible. Right now, for the purposes of this stream, since I don't have that much time, these are the numbers that I'll kind of go with. And I'll do one final check after I look at these figures. Okay, so growing to 23%, 24, 26, or 23.5 basically. I think, okay, so if in 2023 analysts believe that Salesforce can grow to 22%, growing it up to 24% by 2020 or 23.5%, maybe a little bit too conservative. Let's call this 24.5%. So basically, the base case grows it to 24.5%, and then we're decreasing or increasing by 1.5% on either end of the conservative and optimistic cases. Okay, so I feel good with that. Get our switch here. Do I play any sports? I used to play tennis, but nowadays I don't really play sports. I do try to go to the gym as much as possible, but sports I have not played for kind of a while. But I do want to get back into sports. Okay, so for taxes, I'm not gonna create any switches or anything for taxes. Just because I think taxes are not as tricky. Interestingly, most companies have a figure out like Amazon is like a great example. Most companies figure out a way to not pay as much in taxes, but Salesforce has been paying a ton in taxes. Even higher than the corporate tax rate, so pretty odd. But the street thinks that it'll go to around 22%, 21%, then 18% or so. So for taxes, I'm going to just kind of go with what the street thinks for the 2 years here. And then oh, we're in our conservative case, right? That's why our taxes are so, it seems like it's a lot higher. Okay, so let's hmm. We actually want to just be using our percentage instead of the actual figure itself. That's what we'll do. And then we'll just, let's see, 22%, 21%, and then down to 18%. Okay, and then, so this is like what Salesforce you would expect them to be paying basically, because the corporate tax rate in the US is around 19% or so, right? So, I'm trying to think about what would an average look like. 20%. All right, we're gonna just go with that. And in the later years, it's not gonna really like affect our figures too much. So this will be like kind of a rolling average in a sense. Um, take the past 3 years. So eventually it'll get to around 19%, which I think kind of makes sense. Not really the best practice for modeling, but it's like the true number I really want to get at is somewhere around 90%. So I think that's fine. All right, now our EBIOT is our EBIT minus our taxes. EBIOT stands for earnings before interest and after taxes. Okay, now we have our DNA, which we'll link to. So realize I'm not linking to some of these figures. We don't really need all these historicals, but I'll just have them here anyway. Okay, so DNA, our super weird figure. Okay, so our DNA is also going to be a little problematic because it's just so high. And I wonder if a quick Google search will help me figure this out. Probably not here. Okay. So we're going to have to make some rough assumptions for our depreciation here. Let me also look at our CapEx. Those two are really linked together. The reason they're linked is normally you want to see your CapEx and depreciation kind of trend towards the same figure. That's not really the case with Salesforce. All right. So take a little bit of a break there. Okay. So how should we project this? So I think for the next few years, we can definitely, or for these next 2 years, we can look at what the street thinks is going to happen. Because as I've said over and over again, these 2 years are pretty reliable. Really, when we get to these years, that's not very reliable. Let's do that for the first few years, or for next 2 years. We'll go with the street. Then, so it goes from 11% of revenue down to 5%, then to 1%. Huh. See what the numbers directly look like. There's only one broker in 2025, basically. Or, okay, so, but with these same brokers, they do think, the ones that are projecting, they do think there will be an increase, right? In all these figures that you see here. So it does look like 2024 depreciation will increase. 2025 onwards, though, is a huge question mark to me. These figures not pretty reliable. I think we're going to have to kind of just go with historicals, really. So I'm going to be a little bit conservative and have it grow down to a certain percentage because I just don't really see how Salesforce will have this high depreciation amortization when their CapEx is so low. And this is another thing where I would definitely want to spend more time if I have the time and build out like a more fleshed out model. So what I'm going to do here is do another kind of like rolling average thing. Oops. Over the past 3 years. Maybe that doesn't work too well because it increases. Okay. Scratch that actually. So what we're going to do is create another assumption. We'll do that just in this base case section here. So I'm going to need something for DNA. And normally it would be good to build out a bunch of different cases for it and everything, but to be honest, I have to get to class soon. So right now it's around, high teen or low teens. I want to be a little bit conservative and grow it down to something like 9%. Or let's see, based on some historicals here, seems like it was closer to somewhere around 8%. So that's what I want to grow it down to. Again, this is a bit of a shortcut. If I did have more time, definitely something I would want to spend more time looking into. Oops, not mean to do that. So the first 2 years, we're going to use what our street believes. And then for our last year, we're going to take from here. The only other thing is that it might be related to some of the acquisitions that the company has done. Maybe there's a lot of DNA for whatever reason. That divided by last year divided by the number of years. Okay. So 12%, 11%, kind of just decreasing by around 1% a year. I feel okay about that. So let's do that for our DNA. And then for our capital expenditures, let's again go with our street figures for the first 2 years, since this is a street-based DCF. And luckily for our CapEx, it looks like even our estimates here are pretty steady at around 2% or so. So what I'm going to do is just take our previous year and then just hold it steady. I'm marking this red because it's a little bit different. I'm taking the previous year and then that's what's driving everything else, right? So all right. Now we have our change in net working capital. Also super weird. Salesforce is a weird company to be like, or based on what I've done so far, it is quite a weird company to model for. Okay, so let's see what's been happening here. We don't have any projections. So I think this might be acquisition related. Let's go into the cash flow statement. Okay, so let's see. Accounts receivable, deferred commissions, driving a lot of the negative cash flow table, deferred revenue. Okay. Okay, so this is also strange because the company was at around 0 to around 2 to 3% percentage of sales, and then it suddenly dropped to the negatives, probably because Salesforce changed its business model and the way it collects its money. So, or maybe it turned into something like subscription related, and there's like, I don't know. I'm trying to think about how to actually model for this. I don't want to be overly optimistic and take the average over the past few years because, or 3 years, I mean, because that will be overly optimistic. But let me actually try taking average over the past 5 years. I think that will help smoothen out the figures a bit. So if it's around negative 2% or so, that would make sense. So Yeah, let's just hold it flat with that figure. I think this is fair based on the historicals. Another figure that I would really spend more time on, if I had the time later. So, but I think for our purposes, this should do. Okay. Now we get to our free cash flow, unlevered free cash flow. And that is simply your EBIT plus your DNA minus your CapEx minus your change in net working capital. And the other figures we're going to need here are our present value of free cash flow. Then we're going to need and then we're going to need our terminal value. Then our present value of terminal value. Then that will get us to our enterprise value. Then we add cash, track debt. That gets us to our equity value. Then we'll need our shares. That'll get to our implied share price. Okay. So to get our present value of free cash flow, we're going to need to calculate our WACC. And I'm going to pull like a template kind of from my DCF that I did for Disney. Okay, so I would love to do all of this in a lot more detail, but I'm gonna kind of zoom through a lot of this because I have class in 30 minutes and I'm gonna be late. Okay, so market cap, pull from FactSet, currently at 165.2 billion, and this is a rough estimate. Our risk-free rate, I'm going to use our previous figure. So our previous risk-free rate, or actually no, we should go to our 10-year treasury yield. Ten-year treasury yield, 3.099%. 3.099%. Beta for Salesforce, let's find that on FactSet as well. 1.38. Market risk premium is okay, it hasn't changed a lot since our Disney DCF, so let me reopen that. Disney DCF was just around two weeks ago. So was 6.01%. Okay, now we got to figure out how much debt Salesforce has. So let's go into its balance sheet. Okay. So current debt is 1.183 billion, and then non-current debt 9.46 billion. So let's add those two together. All right, and then cost of debt, have a breakdown for us here somewhere. Really, we're just looking for their interest rate that Salesforce pays. 3%. Okay, so roughly around 2 point something percent. Ideally, it'd be great if I had the interest expense figure and then calculate it, but okay, their latest note issuance 2021 was around 3%. So I'm going to go with that figure. If they were to raise, I think it'd be close to what they recently raised debt at. So I'm going to call it 3.05%. So this is a bit of a shortcut. And then tax rate, let's go with their previous or 2022's tax rate. Okay, so the WACC is around 10.85%, which makes sense. I think that's what I would expect for Salesforce. Maybe a little bit high, but not like out of this world. So for our WACC, 10.9% or so. For our be more conservative, I would increase this by 0.5%. And then for our optimistic case, I would decrease this by 0.5%. And then terminal growth rate, pretty standard, 2.5% or 2% here. We're going to use the choose function. Okay. So now all we need to do is pretty much calculate everything. Or calculate the rest of the DCF. Okay, so I named those. Do now. Okay, so we have our present value of free cash flow that we need to calculate. So what we do is get our cash flow figure, divide by 1 plus our WACC. And oops, I got to do one more thing. So I did mention that I was going to do mid-year convention, but it's my first day of class today, and I have class in about 20 minutes. I don't think I can do mid-year convention thing today. Oh God, but this will be really weird if I... Okay, I'm going to try to do it really quickly, actually. Okay, so let's see. We have our mid-year. Okay, so discount period is basically what it's going to be. So the dates are 8, 9. Okay. Year frac. Today is 8/9/22, and then for the last day of the year is December. So if we do year frac, start date, end date, so we have that much of the year left. And then basically what we want, okay, so I don't have, basically what we want to do is, since we have around 0.4 of the year left, the mid-year convention, essentially what we're doing is we're trying to get it by half of the remaining period left in the year of each year. So in this one, we just want to get it in 0.2 times a year later, which is around like 2-ish months. Right, so that's what we're assuming here. And then for our next year, we want to get it at the end of June of 2023, right? So to do that, we're going to need to get this basically gets us to the end of the year, and then we add 0.5. This basically is saying that 0.9 years later, which is the June of 2023, that's what we want to discount to. And then from here, we just want to add +1. So that's pretty much the mid-year convention. I know I zoomed through it really quickly. Sorry about that, but okay, so what we're doing here, getting our free cash flow divided by 1 plus our WACC, and then discount to the year that we're in. Then do the same thing for the rest of the periods. Okay, and then this cash flow amount, actually, we don't want the full year. We only want the percentage left in the year. Is that. So what I did here was I took our free cash flow figure, multiplied it by the number of amount of the year left, which is around 40%. And then I discounted that back to the period left in a sense, which is 2 months. And then for the rest of these, we want the full amount. So that's what we're doing there. Okay. So now let's calculate our terminal value, which is our last year free cash flow times 1 plus your terminal growth rate, all divided by your WACC minus your terminal growth rate. Then present value is your terminal value divided by WACC minus, that is your terminal value divided by 1 plus your WACC, the power of the last year that you're in. Okay, so now we pretty much are there. We just need to get our present value of our free cash flow, present value of our terminal value. That gets us to our enterprise value. Our cash figure we actually have over here. Oh, actually we don't. That figure on the balance sheet. Cash and cash equivalents and marketable securities, 6.931 plus 6.602. And then debt we pulled earlier. Oh, wait, this 24 billion, this 15 billion, is this right? Okay, this actually needs to be multiplied. Okay, so our equity value is our enterprise value plus our cash minus our debt. And then for our number of shares, fully diluted shares 1,034. So then that gets us to our price of $122.78. But don't leave yet, folks, because that is all based on our conservative assumptions. So implied share price versus current share price. So this is a part where we'll be talking about the share price for the company. And this is not what I believe yet, because I don't think we want to be fully conservative on everything. So the current price of Salesforce is at 165.3.23. So this implied upside or downside. So basically, if we were fully conservative on Salesforce, then we would believe that it would there's like 26% downside from here based on the model that I've created. Right. But let's see what things look like in our just kind of more base case scenario. So that implies a share price about 153.61. And then if we were fully optimistic, it'd be around 190.80, which is about a 15% increase. So for me personally, what I think, I always like to start off at the base case. And I think our WACC is a little bit on the like conservative side. So I'd rather be optimistic on the WACC. And then if we look at our figures over here, I think for most of the DCF, I was pretty conservative. So what I would basically say would be the range that makes sense to me is that if we were to keep, this is kind of like a base case scenario for me. If Salesforce were to kind of continue on with what it's doing, and as I built out this street case, I was a little bit on the conservative side. So this is kind of where I see Salesforce. Like I didn't even mean for it to be so close to what it's trading at today, right? Like I built the entire model first and then I got to these figures. But I think right now Salesforce is trading a little bit close to where I believe it should be valued. And the range that I would build it towards is, since I built out the entire model conservatively, I'm okay with making the rest a little bit more, or these three assumptions for our revenue and our EBIT a little bit more on the optimistic side. And so the range that I would have is around $163 to $181. So that provides like a 10% upside. And so that's the range that I would see it at. So if I were to write that out here, it'd be around $163 to $181. Salesforce is a great company. Based on the model that I just built, though, I don't really see it as something that is 100% like the best investment that I would, think is available versus everything else is out there in the world. So, yeah, I mean, not as, I was hoping to get to a much higher figure because I think Salesforce is such a great company. This doesn't mean that it can't go above 181, and it's probably that I was pretty conservative with a lot of my figures. And more recently, the WACC for a lot of companies has gone up a lot. And so you could argue that Salesforce, since it is such a large company, should have a lower WACC than the 10.4% or 10.9%. But I think that's also pretty fair as well. So, but that's pretty much what I believe. I think there's around 10% upside on a discounted cash flow basis for Salesforce. Would not really recommend, personally, I wouldn't invest in Salesforce based on like all of this work that I've just done, but everyone's entitled to their own opinion. So yeah, that pretty much wraps up the model, and wanted to give another reminder to our sponsor, Wall Street Prep. If you guys are interested in financial modeling, it's one of the best companies out there for financial modeling courses. And they have a ton of different courses. As you'll see, if you use my code rareliquid, you'll get 20% off. And two courses I recommend are the accounting course, if you have not really learned about accounting yet, because it's the foundation for pretty much everything in finance. And then, of course, the financial modeling package, which will teach you pretty much everything I learned in banking, which is like financial statement modeling, DCF modeling, M&A, trading comps, and transaction comps. So yeah, with that said, that concludes the Salesforce DCF. You can purchase it later. I'll upload it for $9 on rareliquidcareers.com. And I'm also building out my own how to get into investment banking course. It's not going to go into modeling like Wall Street Prep, but it will go into like industry overview, how to prepare for interviews, stuff like that. With that said, thank you all so much for tuning in to this stream, and hope to catch you in the next one. Thanks all.